job market just delivered numbers that should have mortgage rates falling, but here's the twist. The bond market isn't playing along. What's really happening beneath the surface, and what does it mean for your clients right now? I am Ron Siegel, certified liability advisor, helping financial professionals guide their clients to build wealth through strategic debt management. This week gave us a rare look at the labor market with the government shutdown finally resolved. The ADP report showed just 22,000 jobs created in January when the market expected around 50,000. Even more telling, large businesses actually shed 18,000 jobs, while small businesses added zero. All the job gains came from medium-sized companies. And when you dig deeper, education and health services added 74,000 jobs. Remove that sector, and we actually lost 52,000 jobs across the rest of the economy. The JOLTS report delivered an even bigger surprise. Job openings plunged to 6.5 million in December, well below the 7.25 million forecast. That's the lowest level since September 2020. Looking at just the past 3 months, private sector job openings dropped at an annualized rate of nearly 40%. Before COVID drops, this steep had a 100% track record of appearing during recessions. Now, here's what makes this interesting for your clients. Initial jobless claims jumped to 231,000 last week, noticeably higher than January's average of 211,000. Continuing claims are starting to pick up after hitting their lowest points in September. Companies are clearly pulling back on hiring. But the Treasury market had other concerns this week. The Treasury Department hinted at increased bond issuance down the road. More supply means more bonds for the market to absorb, and that kept yields from falling despite the weak employment data. The 10-year Treasury is currently trading at 4.125%, still battling that 4.2% level that's been acting as both support and resistance. Mortgage rates ended the week around 6.17% for a 30-year fixed, down just slightly from last week. The bond market seems to be waiting for Wednesday's official jobs report before making any big moves. The market expects around 60,000 to 70,000 job additions. If that number comes in lower, we could see rates improve quickly. One bright spot in the housing market, the National Association of Realtors reports that homeowners have gained a median of $150,000 in net worth over the past 5 years. Real estate continues to deliver on its wealth-building promise, with 2/3 of all wealth in the United States coming from home equity. Homeowners have a net worth 44 times greater than renters. Realtor.com data for January showed new listings up 41% month over month, though active inventory still dropped 7% as buyers absorb that supply. That's a healthy sign of market activity, even with rates in the current range. Strategy beats rate always. We work with families on their home financing needs, and we have assembled a complete suite of financial tools for our partners. This week, we want to highlight our rate reduction calculator. Want to know how to turn an existing 6.75% loan into an effective 5.5% interest rate without refinancing? This calculator shows exactly how to achieve that goal. If you would like access to our calculator suite, just reply with the word calculators. We also have several featured articles available this week. One covers a Supreme Court justice who lost $50,000 by writing his own will. Important lessons about proper estate planning. Another explains the car loan tax break everyone is talking about and the costly mistake to avoid. We have insights on rising home insurance costs a buyers need to plan for and the 4 mistakes first-time buyers are making that cost them $72,000. For clients serious about their financial foundation, we have an article asking, what if your financial house is missing 4 critical pillars? All these tools and articles are available on the right side of the dashboard or below this video if you're watching on a mobile device. Looking ahead to next week, we have several important reports. Monday brings consumer inflation expectations. Tuesday gives us retail sales data for December, which will show us how consumers finish the year. Wednesday is the big one. The January jobs report comes out. And as mentioned, the market expects around 60 to 70,000 job additions, with unemployment holding at 4.4%. We get existing home sales for January on Thursday. Friday closes the week with the Consumer Price Index report, which is heavily weighted towards shelter costs. Recent shelter data came in very low, so that could help the inflation picture. The bond market will be especially focused on that jobs report Wednesday. If we see another weak number like we did from ADP and JOLTS, rates could move lower quickly. Remember, refinancing windows typically last only days, not weeks or months. Timing matters. Markets are clearly shifting beneath the surface. Job openings are falling at recession-like speeds. Hiring has stalled and layoff announcements surged in January's to levels not seen since 2009. Yet, the bond market remains cautious, waiting for more confirmation before breaking out of its current range. If your client's looking at home financing, this creates a window worth watching closely. We're here to help families navigate these opportunities as they develop. We appreciate you listening, and we'll speak to you again next week.